Auto insurance is one of those products you hope you never have to use. But when you do need it, it can determine whether an accident becomes a temporary setback or a serious financial problem. At a basic level, auto insurance is a contract between you and an insurance company. You agree to pay a premium, follow certain rules like reporting accidents and cooperating with any investigations, and in return, the insurer agrees to pay covered losses up to the limits you selected. Because driving carries both property damage risk and injury risk, a car policy is really a package of protections, each with its own purpose, limits, and exclusions. The foundation of any auto policy is liability coverage. Liability is about the harm you cause to other people. If you're at fault in a crash, bodily injury liability helps cover the other person's medical expenses, lost income, pain, and suffering claims, and legal costs up to your policy limits. Property damage liability helps pay for repairs to someone else's vehicle or damage to things like a guardrail, a building, or a parked car. Many drivers focus on protecting their own vehicle, but liability is often the most critical part of the policy because lawsuits and medical claims can be far larger than the value of any car. Minimum state requirements can be surprisingly low relative to real-world injury costs. The difference between the legal minimum and financially safe can be significant. Policy limits are commonly shown as three numbers, such as 100/300/100. This typically means $100,000 of bodily injury coverage per person, $300,000 of bodily injury coverage per accident total, and $100,000 of property damage coverage per accident. The per person and per accident split matters because a single crash can injure multiple people. If your limits fall short, you may be personally responsible for the remainder. In serious cases, that can put savings, future wages, or other assets at risk. Many people choose higher liability limits than the state minimum and then add an umbrella policy for an additional layer of protection, especially if they have meaningful assets or income. Collision and comprehensive coverage are what most people think of when they say, insurance for my car. Collision pays to repair or replace your vehicle after a crash, regardless of who was at fault, including single-car accidents like sliding into a pole or striking a barrier. Comprehensive pays for non-collision events such as theft, vandalism, hail, fire, certain flood-related damage, falling objects, or hitting an animal. Both coverages typically come with a deductible. Your deductible is the amount you pay out of pocket before the insurer covers the rest. A higher deductible generally reduces your monthly premium, but it also means you're taking on more of the expense yourself when a loss occurs. The right deductible is one you could comfortably cover without financial stress if something happened tomorrow. If you have a loan or lease on your vehicle, lenders typically require both collision and comprehensive because they want the car repaired or paid off if it's damaged. Once the car is paid off, deciding whether to keep these coverages becomes a cost-benefit decision. If the car's value is low and you could replace it without much strain, you might consider dropping collision or raising deductibles. If replacing the car would be difficult, keeping those coverages protects you from a sudden, large expense. A useful way to think about it is this. What is the most you could lose, and what are you paying each year to protect against that loss? Uninsured motorist and underinsured motorist coverage protect you when the other driver can't. If an at-fault driver carries no insurance or has limits too low to cover the damage they caused, these coverages can step in for your injuries, and in some states or policy types for property damage as well. This becomes especially relevant if you commute regularly or live somewhere where uninsured driving is common. Even when the other driver has insurance, their limits can be inadequate for serious injuries. Underinsured motorist coverage is essentially your protection against someone else's insufficient policy. Medical-related coverages can look different depending on where you live. In some states, personal injury protection, commonly called PIP, is part of a no-fault system, paying medical costs and sometimes lost wages for you and your passengers, regardless of who caused the accident. In other states, medical payments coverage plays a similar but simpler role, helping with medical bills up to a modest limit. These coverages can be valuable even if you already have health insurance because they can help with deductibles, copays, and gaps in coverage after a crash. They also reduce pressure to settle quickly, since medical bills after an accident can arrive long before liability is fully resolved. Beyond the core coverages, there are optional add-ons that can matter depending on your situation. Rental reimbursement can help pay for a rental car while your vehicle is in the shop for a covered claim, which is increasingly useful given how long parts delays can stretch repair timelines. Towing and roadside assistance can cover things like jump starts, towing, and lockouts. Some policies also offer new car replacement, accident forgiveness, or dedicated glass coverage. None of these are universal necessities, but the right ones can turn a real disruption into something much more manageable. One thing that surprises a lot of people is what happens in a total loss situation. If your vehicle is declared a total loss, insurers typically pay the actual cash value, essentially the market value of the car just before the accident, factoring in age, mileage, and condition. That payout might be less than what you still owe on your loan. If you finance the car with a small down payment or a long loan term, you can end up in a position where the loan balance is higher than the car's value. Gap coverage is designed to cover that difference so you're not left paying off a loan on a car you can no longer drive. How insurers set your price is a process called rating, and it's driven by risk. They assess how likely you are to have a claim and how costly that claim might be. Common factors include your driving record, years of experience, location, annual mileage, type of vehicle, how the car is stored, your chosen coverage limits and deductibles, and in some states, a credit-based insurance score. A high-performance vehicle, a long daily commute, and a dense urban area can all push premiums higher. On the other hand, discounts can come from bundling home and auto policies, insuring multiple vehicles, maintaining a clean driving record, completing a defensive driving course where eligible, installing anti-theft devices, or opting into usage-based telematics programs that monitor driving behavior. Telematics can lower premiums for some drivers, but it can also reduce discounts or raise rates for those who show patterns like hard braking, late-night driving, or frequent rapid acceleration. It's worth understanding the terms before opting in. Claims are where your policy becomes real. After an accident, you report the claim, provide details, and document the damage with photos and information from the scene. If you have collision coverage, your insurer can pay for repairs to your vehicle even before fault is fully determined, then seek reimbursement from the at-fault driver's insurer afterward. That can speed up repairs significantly and reduce delays when the other insurer is slow to respond. If the other driver is clearly responsible and their insurer accepts liability, you may be able to go through their policy directly and avoid paying your deductible. But the timeline is often longer. It's also worth knowing that many insurers work with preferred repair shops, but you often have the right to choose your own facility. Understanding whether repairs will use original manufacturer parts, aftermarket parts, or used parts, and whether there's a warranty on the work can help you avoid surprises down the road. The goal of auto insurance is not simply to meet the legal minimum. The goal is to buy coverage for the risks that could genuinely hurt you, not just the ones that feel most visible. For most people, that means starting with strong liability protection and solid uninsured and underinsured motorist coverage, then deciding how much vehicle protection makes sense based on the car's value and your ability to absorb a loss. The most effective policy is one you can afford consistently, with deductibles you could realistically pay and limits that won't leave you exposed if something serious happens. If you tell me whether your car is financed or paid off, your approximate annual mileage, and whether you drive mostly in the city or on the highway, I can suggest sensible coverage structure worth considering.